In this module, we shall discuss about precautionary and speculative demand for money and the portfolio approach. J.M. Keynes gave his theory on demand for money in his book General Theory of Employment, Interest and Money. He stated that people's demand for money does not imply the actual cash balances that they hold, but the amount of cash balance that they want to hold. They want to hold money as it is the most liquid asset, as it can be converted into other assets. This desire to hold money, cash, rather than other forms of wealth, stocks and bonds is called the liquidity preference. According to him, there are three motives of holding money in cash: transaction motive, precautionary motive and speculative motive, and corresponding to each motive there is the demand for money. Learning outcomes. After studying this module, you shall be able to understand what is meant by transaction demand for money, understand what is meant by precautionary demand for money, understand what is meant by speculative demand for money, understand the concept of active balances and liquidity trap, understand the portfolio approach. Let us first understand the transactions demand for money. The amount of money that people hold in cash to conduct their day-to-day personal and business transactions is referred to as the transactions demand for money. Both individuals and business enterprises hold money for transaction purposes. The need to hold money for transaction arises because there is a time gap in the receipt of income while the expenditure happens on a continuous basis. The transaction demand for money is an increasing function of the level of money income when other factors like spending habits of people, price level of goods, etc. are held constant. This can be depicted as MT is a function of Y, where MT is the transaction demand for money and Y is the level of income in the economy. The above function can be written as M is equal to KY, because in the short run the proportion of money income held for transaction purpose is constant. This kind of demand for money is interest inelastic, that is, the demand for money held for transaction purpose is not affected by the changes in the market interest rate as shown in figure. Now we move on to the precautionary demand for money. Apart from keeping money to meet transactions demand, people also hold money to meet some unforeseen circumstances or contingencies like medical expenses, repairs, etc. This holding of money in excess to what is required for transaction purpose to meet unanticipated needs is called the precautionary demand for money. This demand for money too is determined by the income level and is interest inelastic. Its relationship with the level of income can be depicted as MP is a function of Y. MP is equal to function of Y. This shows that higher the level of income, higher would be the demand for precautionary purposes both by households and business enterprises. Since it is also interest inelastic, a curve depicting its relationship with interest rate would be similar to the one shown in figure 1. Active balances, the combined sum of money held for transactions and precautionary purpose both by households and business enterprises is called active balance. This can be shown as MT plus MP is equal to function of Y. Next, we shall discuss about speculative demand for money. This demand for money is interest elastic. When the interest rate rises, people prefer to hold less of money in the form of cash, since holding money as such has an opportunity cost. While when the interest rate are on a decline, if they fall from I1 to I2, the speculative demand for money rises from M1 to M2. This inverse relationship between rate of interest and speculative demand for money is represented in the following figure. Thus, the total demand for money is given by MTD is equal to MT plus MP plus MS, sum of all the three. And the total demand curve would be a horizontal summation of all the three curves. Liquidity trap. It is a situation in which the prevailing interest rates are too low and savings rates are high. This makes the monetary policy ineffective. In a liquidity trap, consumers tend to avoid bonds because they expect that the interest rates will soon rise. Because bonds have an inverse relationship to interest rates, they do not want to invest in an asset whose price is expected to decline. Let us now understand the portfolio approach. Wealth can be held in the form of cash, shares, bonds, government securities, gold, etc. A combination of these assets which the wealth holder holds is referred to his/her portfolio. While holding of cash does not offer any return, but other assets offer returns in the form of interest, etc. The sum of investment in all these assets should be equal to the total wealth of the wealth holder. According to Mankiw, the demand for money function can be written as m upon p raised to the power d is equal to L Rs Rb pi raised to the power e w. Here Rs Rb pi raised to the power e has negative relation and w has a positive relation. Also m is the nominal money demand, p is the price level, Rs is the expected real return on stock, Rb is the expected real return on bonds, pi raised to the power e is the expected inflation rate and w is the real wealth. When the expected real return on stock or bonds increases, money becomes less attractive and its demand falls. When the expected inflation increases, holding money is not preferred. Therefore, the negative relation and the demand for money increases with real wealth, implying a positive relation. Next is utility of portfolio theory in studying money demand. The utility of portfolio theory in studying money demand depends upon the measure of money supply we are considering. The portfolio theories to studying money demand may not be plausible when applied to M1 measure of money supply. This is because M1 includes only currency notes and coins with public, demand deposits of all commercial banks and other deposits with RBI. These forms of money M1 components earn little or interest. The components of M1 are a dominated asset because they exist alongside other assets such as treasury bills, money market mutual funds and deposit certificates, which have the same risk as the components of M1 but earn higher interest rate. Therefore, these other assets dominate M1. Portfolio theories therefore are not able to explain the demand for dominated form of money. Portfolio theories are more applicable when applied to broad measure of money supply like M3. It is in the case of M3 that risk return becomes of utmost importance when deciding on the portfolio. Next is James Tobin's portfolio approach to demand for money. James Tobin is a recipient of Nobel Prize in economics. According to him, wealth holders hold a diversified portfolio consisting of a variety of assets like money, stock, bonds, etc. There is an element of risk in the holding up of securities, and the more the risk assumed, the more is the expected return by the investor. Therefore, the investor tries to obtain a balance between riskless assets such as money, which do not yield interest, and risky but high return giving assets such as stocks and bonds. This implies that the investor faces a trade-off between risk and return. The relationship between risk, return and the process of selection of an optimal portfolio by the investor can be explained through figure in which the x-axis represents risk, on the OY axis return is shown, and on OY dash axis portfolio in bonds in percentage is shown. The investor is a diversifier who considers risk and return as imperfect substitutes. He is willing to take greater risk if compensated by additional return. That is why the shape of the indifference curve is as shown in the figure. The straight line OD represents the terms at which market trades returns for risk and is called the opportunity locus. Point O shows that the entire wealth is held in cash and therefore the return is 0. Point F corresponds to the maximum return that the investor can earn by holding his entire wealth OW in bonds. The line OF measures the risk of the assets portfolio as a function of the percentage of total portfolio held in the form of bonds. Initially, the investor attains equilibrium at point E1, where OD1 is tangible to IC1 and the investor preference converges with the market. Any higher IC is not attainable in the present market scenario, and a lower IC would not be maximizing his returns for any given level of risk. At this equilibrium position, he is investing OW1 amount of money in bonds and holding the rest. That is, WW1 amount of money in cash, his return is U1, while the risk undertaken is R1. The investor is holding a portfolio of bonds and money. The portfolio holding depends upon the bond holding line, that is OF, the budget line, that is OD, and the shape of the IC, that is the nature of the investor. Thus, the investor who acts as a diversifier does not put all his liquid wealth either in cash or in bonds, but puts a part of it in each. Moving on to the effect of a rise in interest rate and the optimal portfolio curve. Suppose the interest rate increases from I1 to I2. This will cause the opportunity locus to pivot from OD1 to OD2. This is because for the same level of risk, the expected rate of return is more due to increase in interest rate. As return is the sum of interest rate and capital gain, therefore, when interest rate goes up, return also goes up. So, this new opportunity locus becomes tangible with an even higher IC curve, that is IC2, where the investor invests OW2 amount of money in bonds, holds WW2 amount as cash and earns U2 return with a risk level of R2. Therefore, when interest rate increases, the investor increases the investment in bonds and reduces his cash balances. Joining the two equilibrium points, we get an optimal portfolio curve, that is AB, which traces the behavior of the investor due to changes in interest rates. Therefore, as per Tobin's approach, it can be concluded that there is an inverse relationship between demand for money and rate of interest. As the rate of interest increases, the portfolio favors the holding of bonds against money. However, it must be noted that the optimal portfolio line is not a straight line, but it is a curve which is concave to the y-axis. As a result, the proportional increase in the rate of interest is possible only when more and more bond holding takes place, such that there is less and less of money to be converted into bonds. Next is money demand and portfolio approach. As the rate of interest increases, the bond holding increases as per portfolio approach. This would imply that the aggregate money demand curve will show a negative relation between rate of interest and demand for holding money. And since money holding declines at a faster rate, the M2 function or speculative money demand function would be downward sloping and would be convex to the origin. MD is the demand for real cash balances. Tobin's portfolio approach provides a better basis for understanding how, in the presence of risk and while holding a portfolio of assets, there exists a negative relationship between rate of interest and demand for real cash balances. Other types of investors. Broadly, investors can be grouped as risk averse and risk lovers. Risk averse investors desire more return for undertaking more of risk. In other words, there is a positive relationship between risk and expectation of return. Within this category, there are two types of investors, diversifiers and plungers. Diversifiers are those who undertake incremental risk only when compensated by more than proportional return. This is a normal behavior and therefore they are also called rational investors. In case of plungers, their behavior is somewhat abnormal because their expectation is that with incremental risk, although return should be positively related, but it could decline in relative terms. In this category, there are two extreme types of investors, those who hold all money and those who hold all bonds. Finally, there is a category of investors who are called risk lovers. They are in the speculative business for the thrill of it and therefore display perverse behavior. Their expectation is that when risk increases, then return will decline in absolute terms. Let us now summarize what we have learned in this module. The desire to hold money, cash rather than other forms of wealth, stocks and bonds is called the liquidity preference. The amount of money that people hold in cash to conduct their day-to-day personal and business transactions is referred to as the transactions demand for money. It depends on the level of income and is not affected by interest rates. It is represented by the function mt is equal to Fy. Holding of money in excess to what is required for transaction purpose to meet unanticipated needs is called the precautionary demand for money. This demand for money is determined by the income level and is interest inelastic. It is represented by the function MP is equals to Fy. The combined sum of money held for transactions and precautionary purpose both by households and business enterprises is called active balance. Speculative demand for money is interest elastic. There is inverse relationship between rate of interest and speculative demand for money. The total demand for money is given by MTD is equal to MT plus MP plus MS. Liquidity trap is a situation in which the prevailing interest rates are too low and saving rates are high. Monetary policy is ineffective in this situation. According to Mankiw, the demand for money function is given by m upon p raised to the power d is equal to L in bracket Rs Rb pi raised to the power e W. Portfolio theories are more applicable when applied to broad measure of money supply like M3. According to James Tobin, wealth holders hold a diversified portfolio consisting of a variety of assets like money, stock, bonds, etc. And there is an inverse relationship between demand for money and rate of interest. Investors can be classified as risk averse and risk lovers. Risk averse in turn can be classified as diversifiers and plungers. Thank you.